The Indian rupee has been on a downward trend against the US dollar. This is not a new phenomenon. However, the pace of depreciation has quickened in recent times. In the first 2 months of 2025 alone, the rupee depreciated by 1.8% against the dollar. This is already more than half of the total depreciation observed in 2024. The trend is clear. The rupee is losing ground. This depreciation is influenced by several factors, both domestic and international. Understanding these factors is crucial to assessing whether a weaker rupee is ultimately good or bad for the Indian economy. The situation is complex, with both potential benefits and drawbacks. The Reserve Bank of India, or RBI, plays a key role in managing the rupee's value. Recently, the RBI, under Governor Sanjay Malhotra, has adopted a more flexible approach to the exchange rate. This means allowing the rupee to fluctuate more freely against the US dollar. This marks a shift from the previous stance of aiming for a more stable rupee. One of the tools the RBI uses to manage liquidity in the market is the USD-INR swap. In February 2025, the RBI conducted a massive $10 billion 3-year USD-INR swap auction. This move injected significant liquidity into the banking system. While this can be beneficial in the short term, some analysts believe it could contribute to further weakening of the rupee. The global trade landscape is another major influence on the rupee's value. Rising trade tensions, particularly those involving the United States, create uncertainty in the market. This uncertainty often translates to downward pressure on emerging market currencies, including the Indian rupee. For example, ongoing trade disputes between the US and its trading partners, including potential new tariffs, can impact the rupee. When global trade is at risk, investors often seek safer havens for their money, putting pressure on currencies like the rupee. While a depreciating rupee is often viewed negatively, it can offer certain advantages to the Indian economy. One of the most significant benefits is the boost it provides to exports. A weaker rupee makes Indian goods and services more affordable for buyers in international markets. This increased competitiveness can lead to higher export volumes, boosting India's manufacturing sector and overall economic growth. Sectors such as textiles, pharmaceuticals, and IT services, which have a significant export component, stand to gain from a weaker rupee. Section 5. The downside: inflation and rising costs. On the flip side, a weaker rupee also brings challenges. One of the most immediate impacts is the rise in the cost of imports. India relies heavily on imports of crude oil, electronic components, and machinery. A depreciating rupee makes these imports more expensive, potentially fueling inflation. This rise in import costs can have a cascading effect on the economy. Businesses that rely on imported raw materials may be forced to raise prices, leading to a broader increase in the cost of living for Indian consumers. Section 6. Investment and the rupee, a mixed bag. The impact of a weaker rupee on investment is complex. On the one hand, a depreciating currency can make Indian assets, such as stocks and bonds, less attractive to foreign investors. This is because their returns are eroded when converted back into their home currencies. This can lead to capital flight, putting further pressure on the rupee. However, a weaker rupee can also present opportunities for certain types of investors. For instance, it can make Indian real estate more attractive to foreign buyers, as their money goes further. Additionally, domestic investors may find it more appealing to invest in rupee-denominated assets, potentially boosting the domestic market. Section 7. Travel and education. Feeling the pinch. For Indian citizens, a weaker rupee directly impacts the cost of international travel and education. Travel to destinations like the United States, where the currency is strong, becomes more expensive. Similarly, the cost of education in countries like the US, UK, and Australia rises for Indian students. This can have broader implications. It may discourage Indian students from pursuing higher education abroad, potentially impacting the country's access to global talent and expertise. Similarly, it can make it more expensive for Indian businesses to send employees overseas for training and development. Section 8. The Balancing Act. Managing a depreciating currency. Managing a depreciating currency is a delicate balancing act for policymakers. The RBI must weigh the potential benefits to exports against the risks of inflation and capital flight. It requires careful monitoring of the exchange rate and the use of monetary policy tools to maintain stability. Communication is also crucial. The RBI's recent policy shift towards a more flexible exchange rate needs to be clearly communicated to the market to avoid unnecessary volatility. Transparency and predictability in monetary policy can help maintain confidence in the Indian economy. Section 9. Conclusion, Boon or Bane, weighing the impacts. So, is the rupee's depreciation a boon or bane for India? The answer, like most things in economics, is nuanced. It presents both opportunities and challenges. While a weaker rupee can boost exports and economic growth, it also risks fueling inflation and impacting investment. Ultimately, the key lies in striking a balance. The RBI's role in managing the exchange rate, controlling inflation, and ensuring liquidity in the market is crucial. Additionally, addressing structural issues that contribute to a weaker rupee, such as dependence on oil imports, is essential for long-term economic stability. Only by carefully navigating these complexities can India harness the potential benefits of a depreciating rupee while mitigating its risks.